Hello and welcome to this Goldmoney Roundtable, where we're going to be discussing markets, the outlook for 2017, and much more. I'm here today with three of my Goldmoney colleagues: Roy Sabag, who's the Chief Executive Officer, Alistair MacLeod, who's the Head of Research, and John Butler, who's the Vice President of Wealth Services. Roy, let me start with you. What is the foremost thing on your mind at the moment, given all the things that we're seeing with the economy, politics, geopolitics? What in your mind is the most important thing at the moment? What are you focusing on?
I think it's a very interesting year, obviously, since the election of Donald Trump, because we're seeing for the first time politics return to the arena, I think, of macroeconomic and even fundamental economic analysis. You have to be naive not to recognize that we're seeing some sort of a shift in, I think, the way capitalism might work over the next few years. The most obvious way I think this manifests is the pendulum is swinging back from capital to labor. For the last 30 years or so, we saw this quid pro quo between capitalism and government, where as long as capitalism engaged or capital engaged in folly, the central banks were able to help them. As long as government engaged in folly, the central bank was there to help them. And I question whether that era is coming to an end.
And what are the implications for markets in your view?
Well, I think if we become more closed, if we get more closed markets and things become more decentralized, which is the obvious outcome of having every economy become more protectionist, then you're going to see a lot of the imbalances that have been kicked down the road have to be cured. Something as simple as trade. No government in the West has really had to think about a trade imbalance over the last 20 or 30 years. They could just refer to their friends at the central bank to figure it out, or their friends in academia. But what happens if all of a sudden the UK has to think about its trading partners, who it's trading wheat with, who it's trading oil with? What happens when Canada has to consider whether it has a trade deficit for grains or for water or for oil or for electricity with another trading party? And I think as it relates to our worldview, when you start to examine who you're having a trade imbalance with, you ultimately resolve that you have to cure that imbalance with a like-for-like commodity, because you can't really settle that imbalance with a service. And when I believe these countries start to say we don't want to accept another trading partner's fiat currency, it seems to me it's not that much of a stretch to see it conclude with a demand for gold payment or a demand for some kind of a commodity basket. Of course, we know that once they start talking about commodity baskets, they ultimately resolve that gold is the best intermediate commodity.
That's very interesting, because there was in the press conference that President Trump had with Prime Minister Abe just a couple of days ago. Trump made a comment to the effect that he's going to bring about fair trade, and it's going to happen much sooner than most people understand or expect, which to me was sort of like, well, is he going to go back to gold for settling balances, or is he talking about tariffs? What do you think, Alistair?
Well, I think gold is impractical for one basic reason, and that is that the US economy is a welfare economy, and the liabilities down the road are enormous. I think if you could look at the American economy rather like an iceberg, and we see the debt above the water, but we know to stay well away from it because there's another 9/10 of stuff, ice underneath the water, because that's the way icebergs float. And I think that is the problem that America has in terms of future monetary policy, because it is going to have to borrow an awful lot of money. And the rate at which that money is borrowed is going to accelerate in the coming years. So coming back to the market side of it, I see rising yields in the US Treasury bond market. And I also see, on a geopolitical scale, a complete change in attitude in Asia towards US Treasury debt for that fundamental reason. Remember that China, Russia, and the whole of Southeast Asia, these are not welfare-driven economies. They're beginning to understand the liabilities that a welfare driven economy is likely to have. And I think that, in a sense, is informing them about their future foreign reserve policy, and it is bringing about a switch in emphasis, I think, away from the dollar, which will take time. And I think that if you're going to go away from the dollar, then obviously, where else do you go? You look at maybe the euro and maybe not. So gold, I think, if only by default, suddenly becomes extremely interesting. And I think this explains why countries like Russia have been accumulating gold, very obviously for some time, and countries like China have been accumulating gold surreptitiously since the regulations that appointed the People's Bank of China as the manager of the country's gold acquisition program. That was all the way back in 1983, those regulations. China has been doing it for a lot longer than people think. So there are big geopolitical tensions, I think, on the relationship between gold and currencies, which could begin to be exposed in 2017.
You know, you're bringing up a point that, let's get back to basics. I'm going to direct this first to John, because I know a lot of theoretical discussions he and I have had. I want to hear your response to it. And then we'll go back to this point. I just want to open this up to all three of you, but let me start with John. Alistair's talking a lot about the dollar, but we have to recognize that there are basically two types of dollars. There's the Federal Reserve dollar, which is what we use today. We call it the US dollar. But the US dollar is what President Nixon stopped in 1971, which was 13.77 grains of fine gold. Now, what's the possibility, in your view, that there might be some separation between a Federal Reserve dollar and a new US dollar being created based on gold, given the some of the things we've been hearing from the Trump administration, some of the advisors that seem to be pro-gold, Vice President Pence, who seems to be pro-gold. What's the possibility of having two monies in the United States, a true US dollar constitutionally backed by gold or silver, and then a Federal Reserve dollar circulating parallel side by side?
Well, two-tier markets are always fundamentally unstable because there's some sort of arbitrage between the two. And the fact is that if they're trading at par and one of them is backed by gold, then naturally everyone's going to hoard the one that's backed by gold and only want to spend the other one, and that will have a tendency to depress the value of the other one. And so it's not a tenable situation.
But how would Gresham's law work in this situation? Might the good money drive out the bad rather than reverse?
Eventually it will, because the bad money becomes worthless. This is the monetary cycle. And if you look at history more broadly and internationally, we've gone through many examples of this, what I call the monetary cycle of history over the past centuries, when a given country has a fundamentally strong, sustainable economy and is on some sort of commodity standard, normally gold, sometimes silver. And then, however, that gets corrupted. In the early US, the Continental gets devalued and corrupted. In revolutionary France, the assignats come in, the greenback episode in the US Civil War, which leads to an outburst of inflation. But then you come back to sound money. The question is, why do you come back to sound money? Because of Gresham's law, because people hoard good money when and where they can find it, gold, silver, other real assets, and spend the bad money, and eventually it gets spent at such a rate that it inflates or even outright hyperinflates.
Yeah.
In this day and age, though, with the entire world based around this fiat dollar reserve standard, where the dollar is the underlying reserve, and it's still a dollar, today at least, that is not backed by gold, then what happens when, as Roy was describing earlier, US trading partners start to think, wait a minute, we've got too many dollars, and
too many Federal Reserve dollars.
Yes, that's right. That's exactly right. You know, what are we going to do with these? Maybe we should start to sell them. And indeed, this has been picking up pace. Now, some people say, oh, that's driven by crisis. Russia's selling because they have to support the ruble. China's selling treasuries because they have to support the yuan. But they're also accumulating gold. If it was strictly a crisis to support their currencies, would they also be accumulating gold at the same time they're selling their treasuries? I think there's a longer-term agenda here. And if you look at the composition of international reserve assets, the dollar's share is declining relative to gold, and it has been for years. Beyond a certain point, there's actually more gold available to settle these imbalances by market value than the dollars that are being dishoarded, that are being spent back into the system. This is a nonlinear process, and it could result in an international, almost spontaneous, de facto remonetization of gold to settle these imbalances in the future.
This is where I'm getting back to Alistair's point. You have countries like China and Russia accumulating gold. What's the possibility maybe that in the future they're going to say, well, we want all of our imbalances between you settled in gold rather than in pieces of paper?
I think it's a great point. I actually have 2 points to make in terms of what you said. A friend of ours that I had dinner with the other night, he said that if you look at the response of the world since QE, the global central banks, if you aggregate them into one balance sheet, they have on the net sold dollars and on the net bought gold. And so there's been an increase in gold ownership by central banks, and there's been a decrease in dollar ownership. And I think taking that back to your point, James, while I do agree that dual markets don't tend to work out, I think if you take a view that this event could be analogous to a bankruptcy, an area that I've got a lot of experience with, you kind of need a post-bankruptcy plan or a plan to emerge out of bankruptcy. I could see a scenario where there is a separation between the Federal Reserve notes and the Treasury bill dollar as a sort of an index where, after a certain event, you can redeem your Treasury bills for the new gold standard dollar, or trading partners could under a quasi Bretton Woods standard. But anyone that's left holding the bag, so to speak, with the Federal Reserve dollar would get, the ability to redeem it into X dollars. And I think that may be one of the ways that inflation gets arrested under such a scenario. The other point that I think I'd like to make is I don't believe that the game theory is just the US versus the world anymore. I think you alluded to it just now. I think it's very likely that these imbalances will have to be cured by even two esoteric countries, which leads to the adoption of a commodity standard to settle imbalances. So for example, if France is going to experience what the United States just did, and Marine Le Pen gets elected, we've already seen that she's spoken to the central bank there about reissuing the franc. So all of a sudden, France has to look at who its trading partners are and who it has imbalances with, and it could just end up setting up a facility with trading partner X or Y or Z, where it settles those imbalances in commodity A, B, or C. And that in and of itself, I just think it's one of those things where this wisdom has been lost. It's been numbed. It's been numbed out of existence, so to speak. And when you kind of have to wake up and realize that this is how the world works, you can't just have these imbalances continue forever. I think it doesn't necessarily have to happen with the US. It can happen with the other 160 different countries around the world.
Let's go back to that Abe-Trump news conference where Mr. Trump was saying we're going to have fair trade sooner than most people expect. If it's not solved, if we don't get fair trade by the monetary side using some kind of commodity as a way to settle imbalances, then the implication would be that we're going to be going into a world of tariffs and maybe even capital controls. Alistair, you want to take a shot at that?
Well, whenever a politician starts using the word fair, I run a mile.
Good point.
And so I really don't know what he means. The only thing I do get a grasp of with President Trump is that his understanding of trade is actually very, very limited. He doesn't understand why trade imbalances rise. They basically rise as a result of unsound money. If you have sound money and people actually have to pay with real money for everything they buy, you don't have trade deficits and trade surpluses. It's as simple as that. So I'm not sure. This, to my mind, I think this is one of the big, big questions for 2017. How President Trump learns about trade, or does he drive us down a Smoot-Hawley route, something like that? I mean, that would be terrifying. I think that the result might be slightly different from what we had in the 1930s, but not much. Yeah, I mean, fair trade, I don't know what he means. I really don't. I think it's just watch this space.
Well, I think he's basically saying that he wants to see the end to all of these huge imbalances. But the question is, how do you get rid of the huge imbalances? And that's your point. If people are willing to take pieces of paper rather than real goods and services to settle balances that way, you're going to have...
But what is the ultimate causality of the imbalance? Is it that the US has this supreme economic power that it's consuming from its partners? Or is it that the US is a debtor nation that through a fiat system, its counterparties are financing a debt-based consumer-driven economy? Who needs more? Who needs more?
Yeah.
Who needs who more? Is it China that needs the U.S. or is it U.S. that needs China? I'm not.
And the other issue.
They need each other. I mean, they need each other. And
but there's time preference.
What concerns me is that, in principle, the division of labor and capital and trading between countries is a fundamentally positive thing. Specialization blended with technology and the division of labor and capital is the base of all economic progress.
Only if, in my humble opinion, you're not hollowing out the whole stack.
And that's the problem, is that I hope we don't throw out the baby with the bathwater, is what I'm saying. Yes, let's reestablish sound money. Let's wind down these imbalances. Let's restore fairness between labor and capital on a global scale. But let's not shut down international trade in the process. That's throwing out the baby.
But trade should only make sense if I have a shortage of bananas because I don't have a natural endowment of bananas or because of seasonality factors. I have demand for bananas and I have an industry that's developed around that. So I trade with a partner that has a deficiency of cows or cattle. That is where trade makes sense. It doesn't make sense to hollow out an entire foundational industry like manufacturing, under the guise of this academic theory that service economy is better, and then find yourself where you have this massive energy shortage. There's an energy deficiency here that nobody's talking about. How do you rebuild 70,000 factories in the United States? It doesn't seem to me to be plausible.
Yeah.
I think that's right. There is another point, actually, just to reinforce what you're saying, and that is that in all government trade talk, whether it's by President Trump or by the existing regime in Europe, they don't give a damn about the consumer. It's always about companies, what they want. It's the lobbying. It's the idea that, and this is where they are so wrong, the idea that there is a trade deficit because someone is dumping their product on us. And it's completely wrong, and it should be. It's not that. It is unsound money. As I go back to this one point, that if you have sound money, you don't have trade imbalances.
Yeah, I agree
not
with you on
chronic
that.
ones, not chronic ones, temporary swings and fluctuations, but they settle.
Within that, I would also include the expansion of bank credit as a source of trade deficits or trade imbalances. If you did away with that and you had sound money, if we were dealing just in gold, if I was going to buy something off you, James, when you're in America and I'm here, and I have to pay you in gold, I can tell you, you would only sell me the goods when you're certain you're going to get my gold. It's actually as simple as that. It's not a question of me getting my government to print some more money or my bank to extend some credit, which they produce out of thin air, for me to pay for the goods which I'm buying off you.
There's a related issue to this because it is, in a world today where we have unsound money, where we have basically unlimited extensions of bank credit, we also have unlimited extensions of government credit. Government creditworthiness cuts through all of this. And we saw a couple of years ago how S&P downgraded the U.S. from AAA to less than AAA. Let's talk about government creditworthiness. Is that it's going to be the problem this year, that people are not going to take government paper because they see the huge debts going up?
I think that. Sorry, I think that is a big problem. Sorry.
Yeah, I'll be quick. I mean, I'm seeing the precise inverse of that. I mean, Italy just issued a 50-year bond, and Mnuchin is talking about one of his first things he's going to do is issue a 50-year T-bill.
But isn't that sort of the height of the bubble?
I'm beginning to think that we're never going to see debt or asset deflation again because they're just not going to allow it. So we have to start preparing for a global hyperinflation. I've been saying that for 2 years. Obviously, I'm the youngest in the bunch, so I'm the most naive. It hasn't happened since the 70s, but it is happening in different economies around the world. And I posit, why can't we see a global hyperinflation? Why can't we see a massive hyperinflation in the West that's analogous to the Weimar Republic?
It's been deferred because interest rates are at zero. If they were paying a fair rate of interest, 5 or 6% on the $20 trillion of debt, you're going to be adding another, a trillion or more to the annual expenses that the U.S. government has to pay in order to just meet the interest expense. 1 trillion is 33% of the 3.2 trillion that they get in revenue. They're not going to cut expenses in other areas, so they're going to borrow more.
Revenue is going down based on what Trump is saying.
Yeah, exactly, because of tax cuts and things of that nature.
And I think it brings back the point, the deficit point. Deficits are fine as long as they're not too large a percentage of GDP.
There's some natural fluctuation there as well in the business cycle, seasonal patterns, regional investment and trade patterns that come and go. But imbalances simply cannot be chronic under a sound money system. As Alistair points out, they have to clear. Markets have to clear. It's Say's law at a global or domestic level. One thing about inflation, though, last year, 2016 was the year when you saw in every major currency underlying price inflation trends clearly shift back towards rising prices. We did see it last year. It's actually behind us now. That trend change is behind us. And I'm surprised it doesn't get quite a bit more coverage in the press. But you've seen underlying core inflation get back into an uptrend in the US. Yeah. You've seen it even get into an uptrend in the euro area. And of course, where it's really taking off for reasons related largely also to import prices is in the UK, where now you're seeing a lot of labor strikes and other things associated with workers, really sensing that they're losing purchasing power. So this is already gaining some momentum. We're a long way from hyperinflation, perhaps, but the move back towards at least clearly rising inflation globally has already begun.
Isn't that the natural reaction, though, when you have zero interest rates and you have banks around the world still expanding credit? Something has to give.
Absolutely.
And what's going to give is the purchasing power of the currency is going to be debased, which means that you're going to have higher prices and rising prices.
The monetary inflation that we've seen in spades post-2008 is finally becoming realized price inflation. But this is only the beginning.
Yeah, but when will we see the tipping point, and will there be an event that causes some kind of movement from inflation to very rapid inflation?
This closed economy, this movement into the reason that you were able to numb this sort of inflationary cycle is because everyone could just transfer export deflation, export inflation to other trading partners. And the central banks around the world really became their own pressure release valves. Everyone's talking about the last few weeks how, look, all the people that said that QE was bad were wrong because the Federal Reserve has stopped expanding its balance sheet now for, what is a few months.
Almost 2 years.
Yeah, almost 2 years. And it depends if you look at excess reserves, though. So the equity markets are still rising. And then I say, well, yeah, but look at the BOJ and the ECB balance sheets. Consolidate. These people all went to school in the same class.
This brings up an interesting point because Alistair pioneered this concept of fiat money quantity, FMQ. What is FMQ showing you right now? Are we heading for inflation?
It's hyper. It's now about $6 trillion.
Maybe we should explain just quickly what FMQ, fiat money quantity,
FMQ
is.
Basically is the quantity of fiat money in the system, and it is the sum of what the Austrian economists call true money supply.
Global system, not just any country.
No, I'm talking dollars only.
Dollars only.
Doesn't matter about the ownership of the dollars.
Okay.
It's the sum of the fiat money in circulation plus the fiat money which is held on reserve on the federal. On the Fed's balance sheet. And that total now is over $15 trillion. There has been a long-term rising trend of fiat money quantity as far back as we can go, and that's I go back to about 1959. But the trend was actually quite well established until we had the last financial crisis. And then the last financial crisis, because the Federal Reserve Board effectively offered an open check to the whole of the financial system, the result is that FMQ took off, and it is now standing roughly 6 trillion above where it would have been if the original pre-Lehman crisis trend had continued. Now we're talking about 6 trillion on a total of just over 15 trillion. So this is a massive monetary inflation.
The implications are that we are seeing the monetary creation that's going to continue to fuel
completely there. Yes.
inflation in the months ahead.
But it's been stuck in this twilight zone of capital. Wait till it gets transmitted back into labor when the
just
pendulum
beginning
swings.
now.
That's when you can get this hyperinflation.
And
So
this is what started last year. We're starting to see this just getting going now. Very beginning.
It's the consequence also of a change in emphasis from monetary inflation as a means of economic stimulation into a fiscal deficit as a means of stimulation, because the fiscal deficit basically brings the production of money through the government, through the agency of the government, into the wider population. And it's that tends to drive up prices on Main Street, whereas with monetary inflation, it tends to drive up the prices on Wall Street.
Well, correct me if I'm wrong, but I don't think Keynes ever, in his general theory of employment, wanted the government to print money to buy assets. It was always to fiscally stimulate the economy. So,
indeed, I think his followers, as it were, have taken what he said to the logical extent. I mean, he actually wrote in the general theory that I want to do away with savers, and I want entrepreneurs to get their money from the government. These were his concluding remarks. So I think his followers are almost trying to take us there by default.
A lot of things are being done in Keynes' name that...
A lot of things are being done by... I mean, he was as Hayek said, he wasn't an economist, and we're suffering for it ever since, I'm afraid.
One thing we also need to put in perspective here is that all of this growth in fiat money quantity and all of the associated growth in debt continues with every passing year to get less and less traction in actual, real economic output. And we're way into diminishing returns.
Yeah.
And this should be a wake-up call to the economics community, clearly, that something is fundamentally wrong. There's, the transmission mechanism is fundamentally broken. And there's been a lot of head-scratching going on over the past couple of years, but they always fall back ultimately on the same set of assumptions and think, oh, just a bit more of that, just a bit more of that, just a bit more of that, and we'll finally get the traction we need. But in fact, if you take the perspective of someone who has seen any given scientific discipline wrestle with facing phenomena that are not explained by its core paradigm, eventually it does all blow up. You see it in physics, you see it in chemistry, and you're also going to see it in economics. There's going to be a realization that these long-held Keynesian assumptions, or more modern neo-Keynesian or new Keynesian assumptions, are simply fundamentally flawed. That you simply cannot manage an economy by printing money, by purchasing assets, or through fiscal policy, that none of this works in the longer term.
Is that what Brexit and Trump election and Le Pen's popularity, is that what people are saying, that they don't like the system anymore? We've got to get a political change in order to bring some common sense into economics?
Well, because what all of these aggressive, unconventional policies have achieved is simply to exacerbate wealth inequality. Yeah. And that is now being perceived by a very large portion of society. And that is becoming a political issue because people do not believe that the economic policies that have been put in place are in their own household interest. And so they're now, what was an economic cycle, a very, very bad one post-2008 that only benefited a small segment of society, has now become a political cycle. And history shows you that this is actually quite a dangerous time because, yes, it leads to trade wars, not just currency wars. It can lead to very aggressive fiscal interventions. It can lead to all kinds of messing around with tax policies that put off businesses because they see so much uncertainty, they're not willing to invest for the longer term. That erodes the capital base. That reduces your potential growth rate down the line. So there are some very dangerous trends underway in the world today.
Well, let me open this up then till 3. Did you have a comment on that or before?
Yeah, I think what I wanted to mention is it brings it back to the first part of the conversation. We have to be very wary to analyze politics. We're not political analysts, no. but at some point, my intuition tells me that we have to be at least 50% political analysts right now, where we are at this point in history, because everything that we're discussing is based on the fact that 8 or 9 people in the world, central bankers, continue to have this hegemony over politicians. And it seems to me like we're seeing the politicians lose their own hegemony over the people. And so the people have now elected a new brand of politician. And so wouldn't it be prudent for us to study this politician? And if you take a look at someone like Steve Bannon, who I've been studying over the last few days, this is a completely different type of person to what we have seen in the White House since the framers. This is an ideologue. And I'm not going to mention whether I agree or disagree. I believe he's a very intelligent man. He's a very well-read man, but he's an ideologue, and I think that he's not the only one. But if I am to take what he said in some of his speeches literally, he is going to take a jackhammer to the institution that has been erected over the last 20 or 30 years. And I think, James, you had mentioned this, it's basically a controlled destruction of these institutions, bringing the power back to the people. And so how can we see, or is it not naive to assume that these 8 central bankers around the world will still be in control or in power when push comes to shove? I really think that's the biggest tail risk in the world right now.
Yeah. Just to follow on from this point, I'll open it up to all three of you. Given the fragility in the system, John, you used the word dangerous, and we talked about the debt and all of the other problems. What's the possibility of a 2008 financial crisis occurring within the next 12 months? Who wants to take a shot at that?
Well, shall I go first? It's ever present, I think, is the answer. And we've been talking about the dollar, but also you've got the political changes that no doubt are going to happen in Europe this year. Are we going to? We've got Greece is already warming up for its crisis, and
that's funny because I thought Greece was saved 5 times already.
You've been reading the mainstream media.
Oh,
have you?
Yeah. Sorry.
There is also a Southeast Asia problem. I've recently traveled in that part of the world, and I've just been amazed at the amount of building going on. And this smells to me like the sort of thing that happens before you get a property crisis, a property crash. It reminds me of London, perhaps, in 1973. It reminds me of when we've gone on holiday to places like Portugal, and you see the cranes are there building these buildings and all the rest of it, and then literally within 12 months, the whole thing falls apart. The builders are bankrupt, and you've got all these empty properties sitting there. I hope that doesn't happen, but this is something that isn't often mentioned, the possibility of another Asian crisis from a repeat, perhaps slightly different, obviously, from the 1998 experience. And there is also, I think, on top of this, you've got this sort of overlay of the unintended consequences of electing someone who, you used the word ideologue in the case of Bannon, who basically has got an agenda and he's going to sort of try and force it through. And the other thing that occurs to me is if we go back to the early 1930s, Hoover was trying to rescue the economy by intervening very heavily. And his opponent in the election, Franklin Roosevelt, the Democrat, said, we've got to get sound money, we've got to cut back government. I can't remember, he basically had that sort of plank, the same plank which I was hearing really from Donald Trump. Almost the same. And yet we know that when Roosevelt got into power, he just turned around completely. And he pursued policies which Hoover had been pursuing, but even more aggressively, to try and get the economy out of the slump. Now, I know the US is not in a slump, but I see the similarity, if you like, in...
But there is a chief difference. The plank that FDR was running on was maybe primarily in economic, it was similar in economic terms, but where I think these guys are ideologues is not necessarily just the economic folly. They have a problem with the core virtue of the nation. They actually see a problem in the qualities of the nation, and they want to revert back to the historical qualities. And I think that to them is a much greater and more important ambition than the economic folly. And in pursuit of that reversion, they will, I think, stomach an economic decline, a necessary one.
I would take the point, but I think that probably illustrates that he could, in defense of the Constitution, in defense of the middle American, the Bible Belt resident, if you like, he probably will have a greater incentive to turn around on his stated economic policies of small government and all the rest of it, and try and deal with the situation that he's actually faced with, which is really what happened to Roosevelt. And we know what happened to the dollar. I mean, he was talking about sound money. And within months of getting in, he suspended, he banned Americans from owning gold. And then within a year, I think in 1934, he then devalued the dollar by 40%. I mean, it's, I just see so many similarities, if you like, from that period. And it just struck me as being very odd. And I'm sure that today's crop of economists won't actually pick this up, because to them, FDR was a hero. He was the man who brought in that the government has got a role in getting the economy around and all the rest of it, despite the fact that he failed to do that completely between 1932 to 33 when he was elected and the start of the Second World War.
Yeah. Which I would argue is what ultimately rescued the economy.
Well, it did. It gave the economy, if you like, a non-free market focus. It involved an enormous amount of government spending. And I think the real rescue, perhaps, was in the subsequent years as the American economy had to move from war expenditure into a more, sort of...
John, do you think there's enough fragility in the economy today that there could be another 2008 in the year ahead?
Yes, the scale of the problem that was revealed in 2008, the scale is actually much larger now.
You mean more debt, more derivatives?
Right. That's right. The system is simply that much larger, and therefore the scale of the potential crisis, the size, is that much larger. And so timing these things is impossible. That doesn't mean we can't look at history for examples on how it might play out. But what happened in 2008 was a banking crisis, as we know. And what ultimately happened was the Federal Reserve and other central banks effectively underwrote the crisis. And they underwrote it with a huge monetary expansion, which is now resulting in a trend change in the general price level, and which is going to lead to a stagflationary mix. And the reason why it's going to be stagflationary is because there is no underlying basis for real growth to pick up, because there's been no real investment over this time. It's been speculation, basically, what we've seen, as opposed to real fixed investment picking up. And so this stagflationary mix is one that is horrific for corporate profit growth. It's going to call into question equity valuations. It's even going to call into question the ability of corporations, leveraged ones, to service their debt. And so there are many potential cracks in the system, but the scale of the problems is simply that much larger. So when it does happen, and it will, central banks will have to step in again to underwrite an even bigger crisis. But at that point, the amount of currency being created may undermine their currencies themselves vis-a-vis real money, gold, silver, and certain other real assets that cannot be arbitrarily printed or devalued.
So when you talk about stagflation, you're talking about slowing economy and higher inflation. Obviously, you're saying this in the US, but you're obviously saying it also for Europe.
Well, the UK is in the lead. Yeah. That's where you're really seeing it.
Yeah, because of the way the pound had dropped, that
Right.
everything has gone up because of the weak currency. But if you look at the banking system today, the banking system in Europe, one could argue, is much weaker than the banking system in the United States. So if there is a crisis a 2008 crisis this year or in the year ahead, is it likely to come from Europe then, in your view?
That's absolutely possible. And going back to the 1930s analogy, it was the Austrian Kreditanstalt failing in 1931 that set off the peak of the crisis in the US with the wave of bankruptcies there. And think about it. If there were linkages across the international banking system back in the early 30s, think how much larger those linkages must be today, with the cross-border investment flows, credit, imbalances, and all of it being an order of magnitude higher. So yes, Europe could well be where things kick off, but the ability for that to be transmitted in a very quick and meaningful way to the US and around the world is far higher than it was in the early 30s.
Yeah, well, let's take, we've had a very good macro discussion. I think there's some clear ideas and clear trends that we see emerging from the year ahead. But let's sort of take this now and bring it into a practical point of view. How do we respond to that as individuals in the markets? What kinds of advice would you be giving to people to plan and prepare for the year ahead, given all the uncertainty that we're facing? Who wants to go first?
I can go first. I mean,
obviously gold is the obvious one, right?
Yeah.
Because you don't have counterparty risk, you have inflation, the price is likely to go higher, it may become a currency again in international trade, settle imbalances, who knows? But I'd love to hear your thoughts on it.
So my view again is that we're not going to get, history doesn't repeat, it rhymes. I don't think we're going to get credit deflation again unless one of these 8 people's authority is questioned, which can happen politically, but is probably unlikely. I think what's more likely is a hyperinflation at this stage, because the system is already insolvent. As you alluded to, it's more insolvent than it was in 2008. In 2008, the private sector was insolvent, but now it's the entire governmental sector in the West. So I historically have always said that I've had a 10% allocation to gold because I like to invest in equities. I like to take risk, and I really can't find even one good large cap long idea in the market today. And as a result, when I take that on the one end, so I don't like equity markets here, I've been quite vocal about that, and I look at my core gold allocation, I think it deserves maybe a 20 or 30% allocation now, because everything that we look at in terms of what fuels a rising gold price environment is here. We have negative real interest rates. There's no doubt to me that because I don't believe we're going to have credit deflation again, in the next recession we're going to see negative nominal rates. It's a tool that they're working on. They're going to eliminate cash to make it difficult to have bank runs. If you've read the book by James Rickards, The Road to Financial Ruin, this ICE 9 concept that they have been working on, where they're just going to freeze equity markets and not allow people to actually sell securities or even ETFs. And even Seth Klarman touched on this in his annual letter, the ETF counterparty risk. So I think you have to be long physical gold to the tune of at least 20 or 30% in this environment if you want to see yourself coming out on the other side.
With other tangible assets representing another large chunk of the other 70%?
Yeah, this is pure speculation, so I want to preface it with that, and I don't like to give personal investment advice, but what I've been thinking a lot lately is it's not inconceivable that maybe equity markets go up 1,000% and real estate goes up 1,000% in this hyperinflation that we're going to see, but then your currency goes down 99%. So your house went from $1 million to 10 million, and your share of Google went from 1,000 to 10,000. But then you go to the supermarket to buy a tomato, and it's gone up 20x.
Yeah.
And so it's the things that need to be reproduced because of physics that have this higher cost, and on the net, the wealth has evaporated, is gone. The real wealth is gone. And so in that scenario, gold will likely hold its value to the tune of 99 or 100%. But that extra 20% is what means you'll actually hold on to your purchasing power. And also the volatility that we're going to see if this happens means a lot of people will make mistakes in the markets and get nervous and sell. So that is just my, maybe there's a 1% chance that happens, but that's beginning to be the way I think this all unfolds, is with just a crack up boom.
Yeah. Alistair, what do you think?
Well, I agree with Roy entirely about physical assets. I think one of the things that does worry me in financial instability is that financial instruments may not have any value. And this could well happen, particularly in the futures markets. And if that happens in the futures markets, then this becomes a really big fundamental problem.
You mean the counterparty risk becomes so great that people just walk away from their commitments?
Suddenly there's a force majeure, which basically means you've got a long contract, which means someone's going to deliver you some gold or wheat or whatever. Tough, it ain't going to happen.
They default and you're just have an empty piece of paper.
You're left there with nothing.
Yeah.
And so physical assets, I think Roy is absolutely right. And also what Roy is saying was true in the big hyperinflation in Germany. I mean, foreign students studying in Germany, out of their allowance, were able to buy houses because of what happened to the purchasing power of the Reichsmark. And also, the whole the whole of society broke down. So what you saw, as Roy said, you saw the real assets, anything that was really tangible, going up in value, whereas the paper currency was losing purchasing power at a very substantial rate. And where you had financial instruments that actually represented something real, for example, a share certificate, as long as the company was able to survive the conditions, then the value of that share certificate rose in nominal currency very substantially as well. So that again fits in with a feeling that perhaps the Dow might go to 100,000 or whatever, but what is 100,000 worth? Not a hell of a lot.
John, what do you think?
I mean, I agree with all of that. I'll add a couple of things. First of all, one of the imbalances that's out there, which we haven't mentioned yet specifically, is that simply between assets and incomes. Assets are simply overvalued in general relative to incomes in general. That is one of the adjustments that's going to have to take place as we finally deleverage the system and finally wind down imbalances generally. What that means then from an investment point of view is that to the extent that you're not simply sitting in gold or not simply sitting in real assets that cannot be defaulted on, cannot be arbitrarily devalued, if you do seek to generate income somewhere, seek to generate it in very fundamental ways that, in a sort of non-discretionary sense, will still find a lot of final consumer demand. That is, when you're in this very difficult environment where people are losing on their assets and have to deploy their income in a very limited way, in a very difficult economic environment, they're still going to need food, they're still going to need clothing, they're still going to need shelter, they're still going to need energy. And I think that's a theme that one can apply in investing. Try to be exposed to the relatively less discretionary areas of spending and avoid the more highly discretionary areas that might have been in vogue in recent years and might have generated phenomenal returns in recent years, but are unlikely to do as well in this type of economic environment.
Let's take a look at Warren Buffett, for example. I mean, here is an investor that said that he would never invest in railroads, and yet he invested in railroads in the last decade. He swore in his annual letter that he would never invest in airlines again, and he's now just deployed $12 billion in the last 4 months and has been buying airlines. Warren Buffett understands inflation. He understands hyperinflation. And I also believe, in my humble opinion, that he understands gold as well as we do. He bought 10% of the world's silver in 1999, and in the press release that Berkshire Hathaway put out, doesn't even like to put out press release, he specifically said that he bought silver because he had been following it since its demonetization. So I think he understands this game as well as we do. And he's out there buying businesses that generally are very cyclical and very difficult to run in a rising interest rate environment or in a low inflation environment. But when you actually superimpose or introduce rapidly rising inflation or hyperinflation, these are the best businesses you can own. Fixed contracts, you own your supply chain, and you can hedge out your energy exposure, your commodity exposure. It's exactly where you want to be. You want to be able to raise prices first so that you kind of are at the beginning of the Cantillon effect rather than at the end.
Absolutely.
Just on that point, what about energy? How's that going to impact on some of these assets? What's your expectation for energy prices? We really haven't.
Personally, again, I think oil is going to $300 or something like that. I think that everyone is so sure that oil isn't going to go back to 100 or 150, and the world is deflating, and the demographics are bad, and fertility rates are down, and we have fracking, and yet oil is sitting here at $60 on the forwards. I personally believe that fracking is going to end up being a major farce. We never should have brought that consumption forward on the energy density tables. Fracking is a manufacturing process for energy. It's not the same as drilling for conventional oil, where you literally stick a straw in the ground and you get free energy. So what we've done is we've transitioned to something that's essentially manufacturing of energy. You inject energy, labor, and time, and you get sort of a derivative of that out. But if you look at the decline rates of fracking wells, they're substantial. You can't even compare to a conventional oil well. So in my view, it's going to be this perfect storm where you get the decline rates from fracking, you get increased internal energy demand because of Trump's vision of rebuilding the manufacturing base, and you couple that with a hyperinflation where all of a sudden you get these nonlinear movements in the price of oil, and it hopscotches to $300.
And it's going to be an inflation or hyperinflation where interest rates still remain very, very low.
Well, as we've learned,
They're going to keep pressure on interest rates.
As I've learned from reading all of your writings, Gibson's paradox, right? When they start raising interest rates, that's when the inflation might propagate faster. The rate of change of inflation may accelerate when people in the economy with the capital start saying, "Wait a second, interest rates are rising. We better consume faster. We better hoard more." And I think that's maybe that will be the trigger. I don't know. I personally believe that, as John said, I was one of the guys that supposedly saw the crisis in 2008. I wrote about it in July of 2007. I wrote an essay to my investors entitled "Reality Approaching." Everything that I saw then, I see way worse now. Everything is way worse. I just see it. It's been absorbed by the government balance sheets. So before, we had this situation where we all thought we were playing by agreed upon rules. There was a private sector economy, there would be a private sector recession, there was private sector systemic financial risk. But all of a sudden we had these central banks, this deus ex machina, printing money. We didn't know they could do that. And since then that has become a policy. It has become a way of being, so to speak. So how can I look at this as a market participant and say that we're going to have credit deflation again, or a credit Anstalt event where 24-hour wire transfer causes the end of the world? I think this is going to end in hyperinflation. They will not cease until the system burns up. And I think that once it starts to burn up, the confidence won't return to the economy in terms of using a medium of exchange and store of value unless it's repegged to something like a commodity basket or gold.
But you made a good comment about we didn't realize that they could print all of this money and we'd have this kind of impact. But we also didn't realize that they could keep interest rates as low as they have for as long as they have.
And get away with it.
I'm sorry?
And get away with it.
And get away with it so far. The question is can they continue to get away with it?
Why have they gotten away with it? Because basically there was around $6 or $7 trillion of capital that was destroyed by the 1% of society, by the elites. And instead of that capital or those assets meeting the prudent saver, so the profligate should have failed, the prudent should have won at much lower asset to income ratios, they printed money to bail out the asset holders, the capital. And so their net worth has all doubled and tripled, just like mine has since then. But the labor's wages hasn't gone up maybe more than 20 or 30%. And so essentially the reason you don't have inflation and they've been able to keep interest rates low is that just it's a simple numbers game. 150 million people are stuck at what they earned 6 or 7 years ago. And in fact, if you factor in technological shifts in automation, the gig economy, they're earning less. Their food, shelter, energy is higher. But all of us with the capital have seen our nominal net worths increase.
And we're seeing the political impact of all of that around the world, and that's probably going to increase, I would think, even more so. Particularly if we go into a stagflation environment with slow economy and higher inflation. I think we're all pretty much on a consensus that higher inflation is going to happen. I guess it's just a question of how quickly and how much. We'll find out, in the months ahead. But obviously, we have to position ourselves for that.
Can I add something to what Roy was saying about energy? What is interesting is that if you look back to before 1970, because of gold convertibility into the dollar, really, effectively, oil prices were tied to the price of gold. And that was going all the way back to when oil was first discovered as a useful product. Between 1970 and very recently, the deal basically was, okay, you can put up your oil prices, Saudi Arabia, but on the condition that with your excess funds, you buy US treasuries. So the correlation moved from the gold price to the holdings of Saudi's US treasuries. That has now stopped. And what's interesting is that we sit here and we have this conversation. We aren't the only people in the world trying to think these things through. In countries like China...
Really? I didn't know that.
I'm supposing. They may not come up with the same conclusions, but in countries like Russia and China, they really do have the problem because they're being asked to take dollars for oil. And they're looking at this and thinking, no, hold on a minute, where is this going? And this is where the point I tried to make earlier, which I think is desperately important. We're talking about a currency and debt issued by a welfare nation. And the amount of unissued debt, which you can foresee, is perhaps another $100 trillion on top of the current debt level of, 20 trillion. So there is going to be a flood of treasuries. So if you're an oil producer like Russia, who are now the largest oil exporters in the world, are you going to want to take dollars? No. On the margins, you're going to want to take something else. Along comes China. China does three things. The first thing she does is she tries to get her counterparties, her commodity suppliers, to accept yuan as opposed to do contract settlements in dollars. The second thing is that she then has a futures contract on the Shanghai Gold Exchange so that you can use your yuan, if you like, in a trade with gold. The third thing, which she hasn't yet done and she has put off, is a yuan contract in oil. Now, the problem I think that she sees about bringing in this contract is the moment she brings it in, people like Russia are going to use those contracts between the gold and oil in yuan as a means of acquiring gold, which is absolutely fine. But your problem is that China has already got, she's still got, in spite of all her spending, over $1 trillion worth of US treasuries. She's going to want to wind that down,
which she's doing.
Which she's doing before she allows the yuan contract in oil to start trading on the Shanghai International Exchange. And that's going to be the interesting thing, I think, in 2017. Will she have reduced her holdings in US treasuries, say, to something under $500 billion? And at that point decide, okay, we can now go ahead with this contract. I think the reason that contract has not gone ahead according to her original plans is that she has woken up to the thought, and I think it is probably a fact in anticipation, that other countries exporting to her are going to use that to sell yuan and buy gold.
Good point, but how is she going to get rid of a trillion or $500 billion worth of treasuries without interest rates going up? I mean, who's going to be the buyer?
The Fed.
The numbers are the Fed.
But if the Fed does absorb that supply,
then of course the dollar has to be going down, right? Because
Yeah.
that's the way they'll absorb it. So you can't have it both ways. You have to either allow interest rates to rise naturally as China and other countries divest of their reserves, or you have to allow the dollar to decline.
I'd like to make one final point and then turn it, but I also think in terms of game theory, I've been noticing that those 8 central bankers have begun to set the stage to blame their own folly on the incoming administration and the kind of ideologues that are starting to ascend the political ranks globally. And I think we have to look at that as well, because this idea of having a political administration battling a central bank or a kind of power structure of central bankers, we haven't seen anything like that, I think, ever. I'm not sure, maybe I'm wrong, but I can't recall a part in any part in history where political administration was squabbling with its central bank. And just imagine if these academics decide, there's 2,000 economists that get a salary just from the Federal Reserve. They're on the Federal Reserve pay, so they can rewrite history however they please in academia, etc. I think it's not inconceivable that they begin to blame the ideologues as this whole thing starts to unwind, and you get this sort of a battle between the two.
I'd like to start moving toward wrapping up here. It's really been a fantastic discussion, and I'd like each of you to take a minute or two just to outline your thoughts for the year ahead, that the thing that you think would be most important that you want to communicate to thousands of people that are going to be watching this video. And then we'll come back to Roy and just add a little bit about Goldmoney, a couple questions there, and then we'll wrap it up. So thoughts for the year ahead. John, do you want to go ahead and lead with that one?
I would say that I think the psychology is going to be very fragile this year, in part because of what we've already discussed about the political uncertainties as well as the economic uncertainties. But one thing to point out is the power of normalcy bias. Behavioral economists and psychologists understand how powerful normalcy bias is. It's so powerful that even as the evidence mounts that something is changing subtly and gradually under the surface, until it does surface, people have a tendency not to respond to it. And that's characteristic of asset bubbles. And that's characteristic of confidence itself in a monetary system and a political system and so on. But you're seeing that pile of evidence grow very rapidly now. It's not just about politics. You're seeing corporate earnings continue to decline. You're seeing price-to-book ratios enterprise value to EBITDA ratios, Case-Shiller PE ratios, all these classic measures of the health of the stock market have been deteriorating for some time. And beyond a certain point, there'll be a realization that all the attention that's been sort of focused on Trump or Brexit or other big headlines, to some extent there's been this underlying deterioration, and there's a frog that's been boiling in water to some extent. So I think the potential for a very sudden reassessment as this normalcy bias corrects is very high this year. And so I think that in that sense, from an investor's point of view, you need to think like the world of insurance almost matters more than the world of investing right now. The key is finding ways to protect yourself.
Protecting wealth.
Absolutely.
Okay. Alistair?
Looking at the US economy, which drives us all at the end of the day, over the last year, we have seen the difference between M2 and M1 accelerate above trend and stay above trend. This indicates to me that there is bank lending going on, an expansion of bank lending, which really means that the underlying US economy has actually been quite strong. I know we have lots and lots of debate about individual figures that, it doesn't look all that strong or whatever, or Walmart are closing stores. But actually, when you cut through all that, the underlying economy in the United States has been going quite well. We now have President Trump coming along, and he is going to stimulate the economy even further. This, I think, is going to lead to overheating. I think it's going to lead to a higher level of price inflation than anybody expects at the moment. It is inevitable. We saw this, incidentally, in 1972-3 in this country here. So I'm fully aware of the dynamics whereby this happens. Now, the result of that is that the Fed is going to have to raise interest rates more than it thinks at the moment, but it has got a limitation. Roy has mentioned the amount of debt. We cannot have a credit event. So there is a limitation to what the Fed can do. So I have one prediction for this year, and that is that at some stage during this year, fairly serious people will start talking about price controls, because that is the only way. We know it doesn't work, but when you've got nothing else to do, when you can't raise interest rates to stop prices rising, what else do? You try and control prices. And I'm not saying that you'll get price controls by the end of this year, but what I am saying is that people will actually start talking about it more and more over the course.
Inflation will be rising enough to cause a lot of discomfort around the country, and people will start talking about possible solutions that will be offered as a solution, is what you're suggesting.
I fear so, yeah.
It's a little bit scary, having seen price controls fail in so many countries around the world.
We know the consequences.
Yeah.
Right. When you think about it, is that really that provocative for Trump compared to like an adjusted border tax or a tariff? I mean, that's like a walk in the park. Price control. And I can imagine the day where he announces price control for industry X or industry Y and what the equities will do. Could you imagine when he announces price controls on chicken, what's Tyson Foods going to do? Or my view is that you have to stay focused. Stay focused. Don't get caught in all of this hype. We have not solved one problem since 2008. If you had capital and assets, you've been fortunate because nominally your net worth has increased. But if you objectively analyze your cost of living, even within the upper kind of echelon, you're seeing that your cost of living has gone up a lot more than the CPI. So what you want to do is ensure that you stay focused and ensure that you come out of this at or near the same level of purchasing power. You want to be heavily exposed to precious metals, and you want to own, I think, property. I'm seeing property markets slow down in Miami and New York, especially in the higher end property. I think there's a massive art bubble. I've been very closely involved in that world over the last 6 months, visiting auctions and learning about that market. I think there's a massive art bubble, so you want to stay away from art, but you definitely want to stay focused. I don't believe anything that's happening right now. I don't believe the equity markets. I don't believe the debt markets. I don't believe the interest rate markets. I think that we're going to see a massive transition, whether it's this year or the next, and it's going to emanate from the politics. Watch the politics.
We do have a pervasive bubble mentality, I think, worldwide. I think that's why I like your point about stay focused. Get back to basics, because I think that's really going to be what we need to do for the year ahead, and try to separate all of the crazy stuff from basics, because inevitably we always go back to basics. And I always like to say inevitably we always go back to gold, because gold is the fundamental basic thing in terms of measuring value and enabling our capitalist society to operate in a fair way. Just to wrap up a little bit, Roy, would you like to chat about Goldmoney? Maybe talk a little bit about that institutional letter that you'd sent out recently, or events that you've got planned for the year ahead?
Yeah, it's been a really great year, I think, if we look back at all that we've accomplished this year. And I think even tying it into what I said, I'm very excited about what we're doing with Goldmoney, because for the first time, people really have a way to not just save in gold, but transact in gold. Over the last year, we've seen us continue to build out our long-term infrastructure for what is a global financial institution that's fully reserved and fully gold-backed. So now you can open a savings account, you can transfer gold to anyone. We've launched U.S. transfers. We've launched U.S. transfers in 47 states.
49 states.
49 now, that's true.
Yeah. Everybody except Vermont. So if you're watching this video from Vermont, you can't do it there, but everywhere else you can.
Exactly. The debit card now works in 7 different currencies. We're able to accept deposits from 47 different currencies. We're able to pay out redemptions in 48 or 49 different currencies. So I'm really proud of what we've accomplished, but we're also staying focused at Goldmoney, because we think time is on our side, and we think we have to stay very prudent. We have a very strong balance sheet with close to $60 million in the bank, and we have a growing base of customers that we provide assurances of integrity for. So in our view, we're going to keep building out the core infrastructure, but we're also going to start pushing more the merchant side. We really want to see our community start to use this service to engage in trade. We don't have to wait for these events that we discuss. Gold is performing as it needs to, whether it's in a low inflation environment where it only appreciates only 8% per annum in US dollar terms, and obviously much higher if you look at something like the pound or the Canadian dollar or other currencies, or whether we get this event that we're all thinking is around the corner, where we get a much more rapid rate of inflation. I think that people watching this video need to open a Goldmoney business account and try it. Pay your employees in gold. If you're an employee, demand to be paid in gold. With a gold payroll tool, it takes 5 minutes. If you're a merchant, if you sell anything, whether you own a small business, a restaurant, or whether you own an online business, use our invoicing tool. Use our new checkout button. Do you run a foundation? Do you engage in any charity activity, whether it's at your local church or synagogue, or whether it's for a specific event? Use our donation button. It's great. It's just like PayPal, except you only pay 1%. And if you stay in gold, it's only 0.5%. So I think this year is going to see us really push on that front, whilst at the same time staying focused, because we think we're in a unique position here. We're building a global financial institution. It's gold-backed. We're expanding into more and more services and product offerings. And I really believe that there's no one else out there doing what we're doing. And what we've accomplished is way beyond what I thought we would have accomplished in a year, or since you and I met two years ago.
Yeah, it's amazing how much has happened in the 2 years since we first. It's not even been 2 years, really.
Yeah.
It's been quite remarkable, and obviously I've been very, very pleased with the progress that the company has been making.
Also, watch for a new business we're going to be launching. Something very exciting.
Okay, and when's that going to happen?
I think May or June.
Okay, well, everybody stay tuned. Well, Roy Sabag, Alistair McLeod, John Butler, and me, James Turk. Thanks for watching. We hope you found this video to be useful. And take a look at goldmoney.com. Thank you very much.